Hello and welcome. You're watching the Mutual Fund Show on NDTV Profit and I'm Alex Matthew. This show gets you actionable insight on everything mutual fund related. Just about a week ago, a letter that was sent by the Association of Mutual Funds in India, or AMFI, to mutual fund trustees with a message from the SEBI drew a lot of attention. It had to do with small and mid-cap actively managed schemes. The regulator was concerned about the massive flows into these two categories, and it wanted mutual funds to ensure that investors are protected. Now, it turns out that could be some changes in the works relating to the disclosures related to stress tests that mutual funds conduct to ensure that their investment portfolios are insulated from a variety of risks. Mutual funds anyway conduct these tests as a matter of course. We're going to get you a glimpse of what that entails. And we're also going to talk about whether or not the management of small and mid-cap schemes has had to change over the last 12 months to account for the massive inflows over the past 12 months or so. Now, the first leg of this conversation I'm going to have with Abhilasha Satale, who is a fund manager equity at Quantum EMC. Abhilasha, thank you so much for taking the time and for speaking to us. Pleasure having you on the Mutual Fund Show. So first of all, I want to understand, are there stress tests that are conducted by mutual funds of their mutual fund schemes in the equity category on an ongoing basis?
Yeah, so I will mention about what we do as a stress test. Obviously, we conduct all the stress tests when it comes to the management of small cap fund. And for us, the minimum liquidity criteria per day is around 2 crores. And at any given point of time, whenever we are building up the position, we will not be more than say 5% of the particular company. Apart from that, for the fund capacity also, we have already mentioned our fund capacity before launching it. And whenever we get to that capacity, we will close the fund. So that's the overall stress test what we are doing at Quantum and while building up any position.
What else do you look at in terms of, do you look at, for example, concentration risk? Do you look at earnings trajectory? What are the other factors that you look at in order to protect yourself from the various so why don't we first of all talk about the various risks that could occur in an equity portfolio and how to counter each of those?
So as of now, the major risk what most of the mutual funds are facing, that is the liquidity risk, because the funds have become a large size, and actually the companies which are there on the listed space, they are not able to take that kind of liquidity. So they have become very suboptimal position in their funds itself, and of the companies, for them, they have become a very large shareholders for some of the companies. So that is a major risk when it comes to liquidating some of the positions in some of the funds. So for us, if we take it at the current liquidity, we will be able to liquidate all our positions within 66 days, 66 working days. So that's the minimum criteria what we have kept for ourselves, and some of the measures what we are taking that I have already mentioned. Apart from that, as you are saying, the concentration risk, and so those are some of the risks which, because some of the sectors have done much better than the other sectors, and, the visibility has turned out better. So that is what has happened, like, some of the funds are concentrated in some few sectors. That is the concentration risk which these funds also would be facing. For us, we remain by and large diversified fund, and we have avoided exposure to very pricey sectors or where we are not getting that valuation comfort. So we have, while building the portfolio, we have taken these things into consideration, and we have built the positions judiciously, taking into consideration the diversified portfolio and avoiding any overpriced positions. So for us, the investment approach is largely GARP, that is growth at reasonable price.
So I take your point, and I understand completely about your own approach to managing this, but I also want to talk about how a fund manager, and not necessarily just one such as yourself, would approach this, particularly in the small cap space and also in the mid cap space, because I'm looking at the last 1 year. And we're talking about inflows to the tune of 42,036 crore rupees as of the end of January. And this is something that is almost unprecedented because of the kind of flows that we've seen from the retail segment over the last 1 year. So how difficult is managing that liquidity? You've been forced, I would assume, or rather fund managers have been forced to increase the size of portfolios. Does the constitution of that portfolio need to change, and how does it need to change to manage the liquidity risk?
Yeah, so as you rightly said, some of the funds have become very large because inflows have been better. These are the segments which have given the highest returns in last 3-4 years, and that is how inflows have been very encouraging for these segments. However, the companies which are listed in these segments, these are largely small cap and mid cap. They are not very high market capitalization companies. So therefore, their capacity to absorb some these kind of flows remains limited. So for a fund manager, as you know, some of the funds have taken prudent measure in terms of capping their flows. So that is one measure which a fund can take, that if they cap the flow and whatever flows are coming to SIPs and all, they invest it judiciously by not increasing the suboptimal positions in their funds. Then that is a one, and consolidating their fund positions. That is one thing which a fund manager can do, because for some of the funds, if you see, the number of stocks held have increased anywhere in the range of 150 to 200, and so these kind of suboptimal positions are likely to dilute the returns for the investor over a period of time.
Got it. Would it be fair to say that utilizing, and particularly in the small and mid cap segments, you have 40% in your assets under management to play with? So you have a combination of large caps where you have, one would assume, better liquidity, and also cash. Are those the two levers to utilize to ensure that you have enough liquidity?
Yeah, so that is also one thing. So for as per SEBI mandate, around 65% of the exposure should be to small cap. So that is for any fund. So any small cap fund will always have 65% exposure to only small cap companies. Rest 35% he can allocate, a fund manager can allocate to either large caps as well as he can also keep a cash. Now, seeing the current market situation, it is prudent that you allocate some money to large cap as well as you keep some cash on the sidelines, because whenever the opportunity arises, then you can utilize that cash to build positions at a lower level. So,
got it. Abhilasha, the last point, and we're looking at a little bit of selling in the market today, but by and large, I think we've seen unprecedented run-up in the broader markets. At this juncture, for deploying fresh funds, and those funds don't seem to be drying up at all, how challenging is it approaching investing in this space, and for you as a manager of portfolios?
Yeah, it is quite challenging, I would say, because for some of the sectors, some of the companies' valuations have run up ahead of time. The stocks are pricey, and there is some growth uncertainty as well on some of the stocks. Like we are seeing that with forthcoming elections, there could be some slowdown in capex spending and all. Although over a longer period of time, over a long term, India still remains in a very at a very best position, or in that in terms of growth and the growth trajectory. But for the short term, it is quite challenging because the valuations are expensive. So for us, how we handle it is like we are, as I mentioned, that we are having GARP approach, growth at reasonable price. So wherever we are seeing that the growth is still sustainable over a longer period of time and the valuations have not run up as much as the market has gone up, there we have built some positions. So some of the sectors to name, like BFSI, still because of the RBI regulated, there has been uncertainty on that sector, but still there are good opportunities, good managed banks which are still are better position as compared to other segments. Apart from that, even some of the auto ancillaries or some of the pharma chemical companies, these are some of the sectors where valuations are still reasonable, and we have some positions there.
Got it. Abhilasha, thanks so much for taking the time and for speaking to us on the Mutual Fund Show. All right. Now, I do want to draw your attention once again to that exclusive news break. And the reason why I was talking to you, or I was talking to Abhilasha about the stress test, my colleague picked up from industry sources that the SEBI might actually require mutual funds to publish the results of these stress tests on public platforms, including on their website, or to AMFI on a regular basis. And that's so that you understand the risks involved in investing into a few of these schemes. I'm joined by Kaustubh Belapurkar, CFA and Director of Fund Research at Morningstar India. Kaustubh, thanks so much as always for taking the time and speaking to us on the Mutual Fund Show. I want to ask at the start, at the onset, the kind of inflows. So we've seen thousands of crores flow into this scheme categories as a whole, but which schemes have received the most funds? That data itself is quite telling.
Yeah. Firstly, hi, Alex, and thanks for having me on the show. And I think very interesting conversation, obviously in the backdrop of what's been happening over the past year, and in terms of obviously the the news and the circular that's come out. So a couple of things, right? So one is, I think the last few years have been interesting from the perspective of obviously equity flows, SIP flows have continued to grow, which is great. But I think what we've also seen is slightly outsized allocation towards mid and small cap funds, as you would see in the flows, especially I think 2023 being a classic case in point, where I think small caps were probably the largest category in terms of absolute flows that came in the calendar year, right? And mid caps probably weren't far behind, probably amongst the top three categories. So obviously, in terms of exuberance from investors in investing in these categories has gone up. And funds have been the beneficiaries of these. And if you look at it, obviously there are several funds that have gotten outsized flows over this period of time, some which are already quite popular and large, and some probably upcoming, right? So if you look at some of the data and we track the inflows into some of these funds, stripping out the market movement, so that's important to think about it as a net inflow that comes out of these funds, you would see the likes of a Kotak Emerging Equity on the mid-cap side, the HDFC mid-cap opportunities, which is in fact the largest mid-cap strategy around, SBI Magnum mid-cap, the Nippon India Growth Fund, the Motilal Oswal mid-cap. I think these were like the top five, which received north of about 2,000 crores in the last 12 months in terms of the overall flows. The same thing is actually even more staggered on the small cap side. So, from the quant mutual fund house, they had the quant small cap, which actually received about 8,000 crores, and their fund size has actually increased multifold over the past couple of years. And 8,000 crores in a single year is pretty staggering for a single fund that we've seen, especially on the small cap side. HDFC, again, I think about close to 5,000 crores. And there's several other strategies from Nippon, Axis, Canada Robeco, which again, north of 2,000 crores. So if I just put things into perspective, obviously, I think, again, what's happened is, the category by itself has gotten a reasonable amount of outsized flows, and certain strategies within that, have probably received a lion's share of the flow. So it's not been a one size fits all, because you would see funds that have also lost AUM, the ones probably which have, in the recent past not done so well. And, the typical sort of investor, behavior where they would look to buy funds that have done well recently. And I think that's also kind of played a part in, certain funds getting outsized flows from that perspective, right? So that's more about how these flows have kind of stacked up. I just want to take a step back in this whole discussion and think about, putting some data there in terms of, remember, obviously small and mid caps have grown in terms of the overall assets that they manage. They're at about, if you just look at equity funds and all, I think they're about 24% combined of just small and mid cap funds. Remember, there are other types of funds that also own mid and small cap stocks, be it a flexi cap or a multi cap or a focus fund, which would also have reasonable allocations to these counters, right? So just purely from a SMID perspective of the funds, it's about 24%. And if you add the others, it'll probably, you'll probably get a much higher number than that. That's one. But I think what's important is the market overall has also grown, right? So I think that's also important to put into context. Looking at the other side of the coin is, when SEBI, for instance, introduced the categorization and where we lying today, I think the large cap buffer itself for the top 100 stocks, it was about 29,000 crores, if I remember right, back in 2018. It's at 67,000 crores today, right? So it's that even that needle has moved. The number of stocks that can qualify, especially in the small cap space, because that's an open sky sort of definition, that's also gone up quite significantly. I think it's north of almost about 450, 500 small caps that are probably more than 2,000 crores on care. So I think the space has grown. Obviously, the flows have been pretty significant. So, just putting that into perspective is how we need to look at this data.
And right, one of the points that you made was quite striking in that some of these schemes have gotten the lion's share. Kotak in the small cap space, and you're talking Quant in the small cap space. We're talking about what 42,000 crore over the last 1 year or so in the category as a whole, and 10,000 of that or 8,000 of that close to is in one scheme, which is quite significant. Now, another aspect which I asked you about was a turnover ratio, and this is something that signifies the kind of churn in in portfolios. And we're talking about a few schemes, including Quant, which I think plays into its strategy, Kaustubh, very, very elevated. And obviously, for somebody who's looking at this data over a period of time, what do you gauge from these elevated turnover ratios, which means the elevated churn in these portfolios?
Sure. So I think largely when you look at the data, right, Alex, most of the mid and small cap funds are kind of buy and hold strategies. And I don't think we've seen significant change in the turnovers. I mean, a huge delta, so to speak, from what they've historically managed. And like you rightly alluded, Quant, by the virtue of its strategy, is a high turnover, in the way they manage their portfolio. So, that is, in a way, obviously, they will have significantly higher turnover ratios than many of the others. It's a part of their strategy. Whether they can do it at a much higher size AUM, that's probably a discussion for another day. But, I think the point being that I think largely the turnover, I mean, just the way the number is calculated, I think I wouldn't say it's outsized. It's probably gone up a few ticks, but nothing that I would significantly worry about. I think it's more about thinking about fund capacity. And there's a distinct difference when we think about what liquidity and what capacity is, and I think that's the crucial point that we need to think about when we look at funds, especially in spaces like the small cap.
In fact, that was going to be my next question, because the landscape, as you pointed out, for fund managers to paint in has gotten larger, has gotten significantly larger, and that's evident in the stock holdings of the small cap funds in particular, where you've seen, for example, I'm looking at the Nippon India Small Cap Fund, which currently holds 205 stocks, and that has gone up by 38 stocks over the last 1 year. That's also very telling, and that means that fund managers have a very different approach than they had a year back to investing in this particular category.
Yeah, so I think it's also about I would say yes and no in a way, Alex, because what's important is also kind of, so when we talk about capacity, right, there are a few things. So one is that the whole discussion around capacity is that can you continue to manage your strategy in the way you envisage, or the way you think is what signifies your investment process? Can you continue to do that consistently, or does size become an issue in the sense that and it doesn't necessarily always underpin on the number of stocks that you're buying, but the underpinning philosophy of what are you looking in the stocks, right? So I mean, if you're a guy who's probably looking at X percentage in ROEs, good, reasonable quality of management, this kind of a growth metric and all of that. And if you find companies beyond that, obviously, I wouldn't mind a manager who does that, and they're probably de-risking by buying smaller bets, especially in a space like small cap. Because I mean, there are two things, right? One is you don't want to take very, very large outsized bets in terms of your own portfolio. And B, secondly, you don't want to own too much equity of the fund, right? Because remember, if you're a 50,000 crore fund, if you're buying even 1% exposure in a stock, that's a 500 crore exposure, and that's 500 crores of a 5,000 crore company. That's actually 10% of the company's equity, right? I'm not even talking about free float, which is a pretty significant chunk to buy or own, right? So I think going down the curve, as long as you're not diluting your core investing process, I don't see necessarily a problem with your stock holding increasing. But yes, I mean, it needs to be put into the context. If we just look at the financial metrics of how a portfolio would look, does it look, reasonably similar? Then, that's fine. I don't particularly mind. Yes, long tails can have their own issues, but sometimes in a space like this, it's okay, right? So, but you need to look at it in that context when you try to evaluate a strategy.
Fair point. The last takeaway, and this is perhaps the most important question, but necessarily has to be a quick answer because we're running out of time, is based on all of the data that we've just discussed, what does the investor take away? How do they change their portfolio if, for example, they're holding units of some of these larger schemes?
Yeah, so to be honest, as a retail investor, I won't pay too much attention to, because these stress tests are useful from the perspective, obviously, the risk management framework for the governance and the board to make sure that the investment team is doing what they envisage, and if there are capacity or liquidity issues, can you kind of take a decision and take that hard decision to stop flows, right? So which a lot of, I think, small cap funds have proactively also looked to do that, which is a great thing. From an investor's perspective, I think going back to the drawing board, think more about from what are your risk return objectives. If you're oversized positions in small and mid caps just because it looked very great from past returns perspective, I think now's a good time as any to start reducing that exposure because we've seen the kind of volatility that small and mid caps have displayed in the past, and there's it won't be any surprise that if they do that again in the future, right? So I think that's most important. Focus on your asset allocation, and that will be, you should be fine with that. Leave the, the risk management and the sort of fund sort of select framework to the fund managers and the advisor who's probably telling you. Focus on your asset allocation. I think that should be key.
All right, and that's a good note to end this show on. Kaustubh, thanks so much for taking the time and speaking to us on NDTV Profit. Viewers, it's been an absolute pleasure bringing you this show. If you've got questions for us, do remember to send them to us on that number on your screen. That brings us to the end of this particular edition of the Mutual Fund Show. Do stay tuned. This is NDTV Profit.